partnership for the last 7 years. Vince is, he's kept me so level-headed, it's unreal. I tend to blow up sometimes and become dramatic with deals, and luckily Vince would settle me down. And I know Evania was always speaking in his ear to settle me down because I could tell. But really an amazing partnership, and I just can't thank you guys enough for all the growth and all the passion and pleasure you guys have shown me over the last 7 years, and really do appreciate it. So thank you.
Well, it was a fun journey, for sure. But we're still going to be around. We're still going to be coming to Breakfast Club and stuff like that. So we'll definitely be networking with you all, and looking forward to that. But I'm Vince Ku. Do I do my, yeah, I got my 30 seconds.
You do whatever you want.
I have some masks. So my name is Vince Ku. I'm an investor. I am selling a portfolio in Cleveland. So 5 properties, 350,000, 1% beyond the 1% rule. So you're looking at 70,000 per property, and they rent for about $800 a month. So if you're interested in that, please let me know. One of them is a duplex, the other 4 single-family homes. So I'm looking to 1031 exchange that into something here in Colorado. Looking for another sober living or vacation rental here. So if you have any leads on something like that, that would work. Something up in the mountains, or it'd be a property in around Denver, maybe on the north side, that has 5 bedrooms plus 3,000 square feet, has plenty of parking. That's what I'd be looking for on the north side.
Price point?
Price point? 400, 450 would be good. Yeah. We can find something that we'll be willing to fix it up. So anything like that would be fun.
Might be able to get you a double check.
Number is 303-907-8763.
Good morning, everyone. It's a little bittersweet. It's like we're saying goodbye to the Wedding Breakfast Club, but it has been a great journey, and we are excited to have like a new chapter and kind of see what Jim and Tim do with this club and the best success with Jim and Tim. It's going to be confusing, right? Anyway, my name's Evania, I'm Vince's wife, and we've been investing for over 10 years. And I'm also a realtor with the Better Way Realty. And like Vince said, we have a portfolio of houses that we're interested in selling, doing a 1031 exchange. We're also open to homes on the western slope. And so with our price point, we're probably going to be looking more in Pueblo, Greeley, Grand Junction, something like that. So if you have any questions about getting started in real estate, we have seen it all and worked with a lot of people in different stages of their investment journey. And I'd love to work with you as a realtor if that's what you're looking for. But also the newsletter. How many of you got my new newsletter yesterday? Okay, if you didn't, please come see me. Give me your card or something, make sure that you get on the list. But I'm going to continue to do the stats and everything that I've been doing for the newsletter, just in a new capacity. Our business is New Day Real Estate Investments, so kind of doing it under that umbrella. And yeah, we've worked all that out. So if you want to continue to receive that information, I'm more than happy to take your information and get you on the new newsletter. But there's going to be some transition because it's all new. So I'm not sure all the links are working and everything else, but we'll get it all squared away. So yes, thank you for coming and supporting this group and supporting us and just networking with us and helping us to grow as investors, and just love the relationships that we've been able to build here. So we want to keep that going. Thank you. My phone number is 303-907-7569.
Thank you, guys.
Thank you.
We do concrete and foundation sales. for Groundworks Colorado. So if you got any concrete issues or foundation issues, just call me directly, 303-517-9197. So now is the time we're going to go into talking about market, local, national, whatever we decided to go. I'm really looking forward to this. I'm going to come out there, not use the microphone anymore. And since we're not using the microphone anymore, you got to speak loud, okay? Try not to jump on top of each other. I'll call on you. But this is really probably the most valuable part of the meeting. It really, truly is. Every time I'm done with this, I think about how many things I learned from this room. So let's talk about the local market. We seen a crash? Are we gonna have a crash? Anybody? Huh?
In transactions.
In transactions? Okay. What else are we gonna see a crash? Now, no negativity.
The only thing I can relate to is a report I saw on July about foreclosures up 400% over last year. Now that 400% over last year, that really doesn't affect Colorado because of all of the cities around the country. Colorado is one of the bottom 5 lowest. But in the top 5 lowest are all the southern states of Louisiana and Alabama, those kinds of places that don't have the equity that we have here. But that was July's report, and it's going to not stabilize. How's that? It's good to try to be updated. But that's just one of the things. I believe the Fed coin, which is the crypto, every government is going to have a crypto, their own crypto, and the Fed coin is right on the verge of coming out. And that's something we really don't want. In fact, Ed Perlmutter is a deciding vote that is up for Congress, or for election, not election, for vote in Congress right now. And we should all write to him and say, we don't want the Fed coin because that is a digital currency that is going to control your lives. Let me assure you of that.
All right, thanks, Al. Ray?
What do you think, so like the last 2 years, we've had this mortuary, what is it called, where COVID relief, there you go, thank you. Where COVID relief was a thing, so they didn't have to, how many foreclosures were back then, you know? Do you think that 400% increase is an actual number? Because the last 2 years, a lot of people were able not to make their mortgage and didn't go into foreclosure. What, do you think that number's, you got anything on that?
Regarding foreclosures, locally, we're not going to see a ton of foreclosures because there's so much equity.
Exactly.
There's tons of equity. Now, there's a lot more inventory, right? And buyers are kind of, it's crickets right now out there. Our neighbor just sold their house. They did go under contract immediately, but it was a nice fixed up house. So it was they kind of house hacked that one. But because people have so much equity, in theory, there shouldn't be a ton of foreclosures because they could just sell their house. But there's going to be an uptick. But I think the market can absorb that. Right now, the houses that are sitting on the market are ones that need a little bit of work. And it doesn't take much. I was out showing houses last weekend, and there was a perfectly livable house that just needed a few things. It needed some work to the stairs, and it needed a new concrete slab on the patio, and you know, the basement could use some baseboards, like very, very basic, maybe some paint. And it was on the market. They're down $50,000. This is in Aurora. It was at a lower price point. So there's a shift happening in the market right now, and I think it's going to get worse before it gets better. I
I'd like to hear what other people are thinking too, but I think prices are gonna go down. I think there's a correction happening. And if you're seeing it at the more affordable levels, like in Aurora, under 500,000, then, if it's happening there, it's happening across the board.
To your point, I live in Inglewood, which in the old, not in the tech center, in the older section, right off Broadway. And there was a house across the street that was listed for $600,000. If you're going to list it, try to play in the market and try to get best price, you've got to finish the house. I walked in, and a friend of ours had sold it to an investor. I walked in there, the appliances were 10 years old. All the little touches weren't done. Little things that, the stairwell wasn't painted. Just little touches all through it. It used to be you could get away with things like that. They're down, they started at 600. Last I saw, they were down to 515, took it off the market because they're gonna have to make some improvements to try to go back in there. And they have had that thing on the market, or has been listed with a couple of different realtors for a good 3 months now. You got to finish out the projects because they want, with interest rates going higher, even if prices are coming down, buyers are still stretched to the max in their budgets, and they don't have anything left to fix stuff up.
A lot of people like Ray and Presley and myself don't know how simple those things are really to complete. You're talking about $75,000 cut in price. $75,000, I'll go do it for you.
I'll go do it for you.
To piggyback on the 400% number two, because what is Denver right now at days on market? Wasn't that at 8 that I saw for that newsletter? Well, if it goes to 16, that's 100% increase. And so we're dealing with very, very low numbers. So when the news does a really good job at saying this whole world is collapsing on itself, well, 400% increase. 400% of what? Because it's about the lowest that it's been. I mean, unless somebody correct me.
Well, you have to look at it this early in the market as a trend.
Sure, exactly.
And right now we're looking month over month. You have to.
Well,
and if you had a couple of percent last month, you extrapolate that out over the year, and that's 24%.
Right.
So will it do that? I don't know, but I think the whole sentiment here is be freaking cautious and buy right.
Well, for your point, though, too, it is in 2008. We have equity in homes, and then also the credit reports, the people, the owners. It's just a different boat.
Yes, but we didn't have inflation in 2008. We didn't have stagflation in 2008. People can't afford to drive a freaking car to work. You've got to look at the affordability. People are just like, you know what, I'm out. And the recent report I heard on, for example, apartments are being way overbuilt. There's plenty of places for people to live, and rent's going to start coming down. So
it never has been.
It will.
Oh, it has.
It will.
You bet. You were hearing that.
Because if you can rent for 30% less than you can buy, which is about the number right now,
Yeah.
and you're going to have to come up with several $100,000 down payment for a house, you're going to rent.
Agreed. But over the long term, rents are going to stay down.
Right,
that's it.
In the history of our civilization. Look, it's a big question. I'm trying to get to the bottom of it because we're trying to invest. So, but thanks for the pushback because we're just trying to figure it out.
If you haven't read the book, The Great Reset,
Now you talk about that.
I'm just saying, that really talks about where the global market is, and everybody needs to understand that, because it's going to affect you here today. Absolutely.
I do not believe that you should look at 1 month reversal and extrapolate a trend out. I don't believe that for 1 second. In this crazy world that we have now with great shortage of housing, in Denver particularly, this could be a blip. And I don't know why this has to represent a 6 or a 12-month trend. I just don't believe it.
The only reason I believe it's going to get worse, it kind of depends on the Fed. If they continue to raise interest rates and interest rates keep going up, it's just going to put more burden on buyers.
I don't think the Fed will wreck the housing market. I think they do a lot of jawboning about it. I think they threaten to raise the rates. If the housing prices have collapsed 20%, do they continue? I don't think so. I don't think they go any higher at that point.
Based on what?
So they're trying to bring inflation
Based on
down.
the belief that they don't want to wreck the housing.
Yeah, but it's not the Fed that's going to wreck the housing market. It's the rest of the economy. It's the credit bubble. It's all the other bubbles that we have. Unemployment's going to double over the next 6 to 9 months. If you're looking at any leading indicators, there are.
But if you're looking at the indicators, the jobs report says it's going down. It's gone down every month.
That's not the problem. The problem is underemployment. So listen, reference Neely Tamiga, Alfredo Chang, and Bobby Q, an economist. If you go to Clubhouse, even if you want to see what's going on in Twitter Spaces or in the corporate world, these are the C-suite advisors that are navigating and managing this at scale. Look, I've been quiet and a little bit just kind of giving you a little bit of indication, but this has been my science, this particular market for the last 8 months. You have been in decline. It's reality check right now. We are a top 5 MSA for decline and shift. The question is, when will it stop and when will it settle? What will those indicators be? I'm not worried, as I've said before, about Potter Highlands and Highland. They're going to be fine. It's the rest of the part of the ecosystem that has falsely gained through interest rates, especially in an extended equity runway over the last 2 years, a lot of appreciation that it didn't deserve. We were already ready for correction by all of the buddies that I talked to who did thousands of deals in Denver. Okay, thousands of deals, not just the 20 or 30 here or there. We were all ready for correction 2 or 3 years ago. We didn't get it because interest rates went low and it pushed us forward. Now we just need to understand the correction. The best way to protect yourself is to ask yourself the strike mark of this market. What was that like pre-corona? Whatever that was pre-corona, go back and say, are you going back there? Are you going below there? Or are you going to stay above there? Highland Square and Wash Park, anything under 2 million, it doesn't get any better than that in Denver proper. Okay, Applewood of Wheat Ridge, and over there in we're in Columbine, the Red Rock area, I can't remember. Those places, King Carl, yes, and Beaumont, they're fine. Look who lives there. Look who bought there. The biggest 5 outliers that are not why we're not Fed dependent: global capital, big realty, institutional capital before and after acquisitions. The one thing that's going up right now is short sales dramatically, even in Denver. Life circumstances don't stop for divorce, for death, for job, for unemployment, for underemployment. So the biggest thing right now, I've got 7 different short sale experts that I'm working with that train this across the country with thousands of realtors, and they have gone 400% or 500% of realtors signing up for short sale. 2 big reasons. Number 1, smart realtors see it coming. Number 2, realtors are losing tons of business, so they want to figure out how to get this. So the biggest thing you have to realize is preemptively now, institutional is straddling and hedging on both sides. They'll get the stuff that comes out, and they'll get the stuff before it comes out. They will broker the big deals with the big banks before we even see the opportunities, and that's the unfairness, and that's why the Fed no longer controls us, because Fed is impacted by Main Street. It only partially impacts big real estate and institutional real estate. Last thought of all this is the fact that you want to be well aware of what's going on with rental correction, because everybody talks about supply and demand. The affordability narrative has been the dramatically understated, as we've said, narrative. Rents are correcting. People cannot afford to pay rent. And you can get $2,600 in the door, but if you can get that 12 months later, 24 months later, we will see. When you move to the Midwest, you know that renting doesn't matter. The rules change because disoccupancy is a massive issue out there. Hard turns, if you can get them out, eviction, if they come back and wreck the property. So it doesn't matter what we think we're getting, we'll only know through operators and landlords and investors at scale with a collective conversation like this, where we're really at, if they can afford to pay rent 6 or 18 months from now, with everything else that they're dealing with economically, for starters.
Bottom line is buyer beware.
That's always.
I will ask that.
But look, guys, historically, buying and holding real estate, it's not sexy, but it's a safe investment. Like historically, 4% year over year. If you got $100 grand to invest, and you invest that in the stock market, after a year, if we're generous, we say you made 10%, so you made $10,000. If you invest that same 100 grand in real estate and you leverage that, you buy a $400,000 asset. If we're super conservative and say you get 4% appreciation, your 100 grand is made $16,000. So just buy. It's why the buy and hold strategy, it ain't sexy, but it's effective, and history proves that.
Yep.
If you bought a buying home in, I don't know, 2008, 2009, you probably 10 years before you started seeing that 4% appreciation.
But that's 2008. That's a anomaly.
It started moving in 2011. It started moving back up in 2011.
Took a few years to buy.
Yeah, even 2008, they were more than 10 years, what I saw in Denver.
Yeah.
It was like you said,
It was
like
6
great.
years. It was 6 years from 2006 till you got made whole in 2000.
Yeah. 2012. And then
I think we're at about 2008.
But that's
But
market
I do-
dependent.
I think the Fed is not going to want to tank the real estate market, but right now they're very focused on inflation, bringing down inflation, and housing costs is a big factor in calculating inflation. So they need prices to come down to make inflation look better. But you're right, at some point they're going to stop. But they did say it's going to be painful. It has to be. We have to bring it down. But personally, I think inflation is coming no matter what they do, because it just costs more to live. People are going to demand higher wages, and once wages start to catch up, then we're just in a time of inflation. I don't think there's any dialing it back. We just have to slow it. But at some point, they unleash so much money into the economy. At some point, the market's going to catch up one way or another. So they're just trying to make it. So they're just trying to slow it down, but they're not. It's not like you can go back. It's not like that we can just take that money back. Quantitative easing is when they put the money out. That's what they call it now, and it's basically printing money. And then what do they call it? Quantitative tightening is it's not. I don't think it happens. It's not. You can't. Once the money's out, it's out. And so at some point, everything's going to cost what it's going to cost. Just like back in the 70s, you could buy a house for $50,000, but that same house today is $500,000. Inflation happens, and the goal is basically they just want it to slow down, but at some point it's going to catch. I don't know if it makes a difference, honestly. Whether we go through
Housing's not
fast or
factored
slow,
into inflation, though.
we're going to get there. And so for us, it's just what moves do we make now? I personally see there's a lot of opportunity in this market because we finally have this spread. Our bread and butter for the longest time has been fix and flip. We have not been fix and flipping in the last year because there just haven't been any deals. So being extremely cautious is the key, especially if you're fix and flipping. Don't do a bad deal. I think telling that guy to walk away from $10,000, it was smart. He should have never put down $10,000 unless he himself knew how to estimate the repair costs. And that's what the Invest Success program teaches. And probably the most valuable part of that program is learning how to estimate the repair costs. Don't put down money until you can do it yourself. Don't rely on contractors. Don't rely on the wholesalers' estimate. It's wrong. I'll tell you right now. It's always low. It's always on the best case scenario, and chances are it's going to be more. So you have to learn how to do those things.
Can I do just a general question to the group? What do you think causes inflation?
Losing money.
too much money.
$2 chasing to US.
Okay, so what do you guys think are the solutions to inflation?
Stop giving free money.
Sucking the money back out of the system.
Do you think that raising interest rates is a solution to inflation?
Nobody does.
Who do you think is impacted by the Fed raising their rate, and which causes the prime rate to go up, and then the lenders charge us more money?
Everyone.
Do you think that is a solution? Why don't you think that's a solution?
Well, it did in the 80s with Volcker. It calmed down inflation when he jacked it up to almost 20%.
I haven't researched it.
Paul
But
Volcker
it
in
is-
the 80s, they jacked up to 20%, and they immediately calmed everything down. So
We hit a hard break.
Bankrupted a few people in the process, too.
We hit a hard break in March. It impacts a certain portion of everyone, people who, right, if you're buying a home, but it doesn't impact all the homes that are bought. I'll reiterate, that the first quarter of this year, 30%, 28% of all homes purchased were bought by hedge funds. That means almost 30% of the homes that were purchased are rentals by large groups and not out here for individual investors to buy, homeowners to buy. Yes, that's increasing the rates to keep homeowners from buying. It doesn't make any sense to me.
And looking at history,
Yeah, if you look at the national markets and where the cities that are hurting the most are the ones that had the most growth the last few years, right? So it's like Denver, Austin, Seattle, California, all these markets that, Boise, Boise. These markets that just grew so big because of how low the interest rates were, and people wanted to get out of their expensive areas and move out to other places during COVID and stuff like that. That's where we're seeing the hit on the interest rates. But if you go to like Midwest and stuff like that, nothing really has changed. And like probably North Carolina,
Exactly.
Things are still strong. I sold a house in Cleveland first weekend. I was like, okay, I'll take that, sure. It's very different, but the interest rates on that small of a price point doesn't really affect it that much. But our price points are so high that we're feeling it.
I've seen that in North Carolina. Most of the things that I look at in North Carolina are east of I-95. I'm not looking in Raleigh and Charlotte, because Raleigh and Charlotte look like this. And you get about, for rentals, you get about the same percentage. You're doing good to get half a point, just like you are here. But east of I-95, I look at markets like, firstly, Fayetteville, Jacksonville, Goldsboro, Havelock. These are all military towns. Fort Bragg, Camp Lejeune, so on. So built-in rental markets. There, the market's still active, and believe it or not, you can find close to 1% if you look. You get, and your dollar goes a lot further. And like I say, the interest rates don't make as big a difference when you're looking at buying houses for between $100,000 and $150,000. Just depends on what you're looking for. You could find things like, you could buy a fourplex of nice two bed, 1 bath townhomes, great rental properties for military areas, or 3 bed, 2 bath. You can get a fourplex for $500,000 with rents close to $1,000 a month per unit. So your numbers look a lot better. That's why I like those markets.
Well, I love this conversation.
So back to what Tammy was mentioning about REITs and hedge funds and stuff, I'm starting to see those companies, the big investors, are starting to move away from places like Denver, and they're buying in Cleveland, and they're buying in Kansas City and Fayetteville or whatever, because they can get a better return in those areas, and those markets are starting to go up in price as well.
All those houses are going away, they're going off the market, and they're never coming back. So that contributes to the short supply that we already have. They'll never be available for first-time home buyers. That's what they're buying, first-time home buyer homes. They're never coming back. The continual shrinkage of supply.
But the millennials don't want those homes anyway. They want 4 bedrooms.
First-time home buyers want first-time home buyer homes. Somebody wants.
They want them who can afford. About the millennial and younger generation, they're skipping the 2-bedroom, 1-bath house. They're going straight for the 3-2 or the 4-3. They want the house they grew up in. They don't want a starter home. It's interesting. It's just their mentality. They want more now. I think it's willing to spend, and they have so much debt, which is why they need, forgiveness of their student loans, because they have. I don't know. Are they gonna? The millennials are already in their 30s, so they're not like they're have this mentality. Maybe Gen Z will be more open to the 2-bedroom, 1-bath houses, but that's one of the phenomenons in this market. I read a whole article about how they just don't want those houses.
But how do they afford?
But they'll rent them.
But how do they afford those houses?
Making money online.
They rent rooms out there.
They get creative.
Double income, no kids. They're dinks.
They're dinks, yes, and they're not having kids.
What about their parents?
Remember though,
Some of the parents are funding it.
the presidential election is my favorite, little story. Like what's going to happen. So the Dems own the House and the Senate. You think that they're going to let skyrocketing inflation happen during the presidency elections? It's like, no. So they're probably going to shoot it up now so they can taper it off then. So like, yeah, we're going to see a little bit of pain, but like, you really think they're going to let the inflation be that skyrocketed high? Well, not inflation, excuse me, interest rates.
For
the next year. And then they're gonna start dropping it, and it's gonna stimulate the market, and then the prices are just gonna come right back up.
Exactly. So if you can sign a deal now, like, there's always good deals to be had. It's fierce right now, but like,
But hold it.
I think part of the reason they're buying the big houses is bragging rights. A few years ago when I first moved here, I did Lyft, and I'd have all these young kids in there going, they were bragging about paying more rent for these big condos downtown. Oh, you're paying $5,000? Oh, I'm paying $1,000. Oh, I'm paying $2,000. It was a bragging right. You're in a closet. I've got a 3-bedroom, and it's just me by myself. They're not the sharpest knives in the drawer, but
Status is important. Don't sell your rentals now because you already missed the top. You can't call the bottom. It's too hard to time the market. There's tax consequences. And things will be back. And it may take longer than you like, but I follow this myself. I'm not selling my rentals. I don't think I'm ever selling. The best advice I've ever heard is just don't sell any product.
John, Carter.
Well, the Fed's got two mandates, employment and inflation. They're not worried about the markets. They get scared when the market responds positively, as it did last month, when rates went up and the stock market went up. Piss Jay off. Jay stumbled last year when he talked about transitory inflation, and he's trying to save face. He's short for this world. Whale's going to take over. She's as hawkish as they come. And you're going to see a 6 1/4 prime. You're probably going to see a 7% prime before we're done. The good news, I always look for the good news. Producer price index came down, and the divergence between it and the consumer price index bodes very well for a very strong fourth quarter earnings report. Money's going to come sucking out of the real estate economy and going back into the stock market. I'm not worried about the REITs and institutional buyers. They're doing stupid deals as they have for decades. They take people's dumb money and invest it, and they don't care about the return because they make money off the transactions, and they're good at it. That's what they sell you. And they find places to park your money, and if you break even, you're lucky. I don't believe in the REITs and institutional buyers. As anybody followed the commercial market, Energy Center downtown, the former World Trade Center, went on auction, and they lost millions on that deal. And you're seeing more institutional auctions of office buildings across the country. And if you look at the divergence in price point from when they purchased it, that's what you're looking at for the real economy in terms of what real estate's worth. Auctions don't lie. That's what people are willing to pay for a piece of property. And it's going to trickle down through the single family homes. And yeah, the institutional buyers are sopping up all the first time home buyers markets. I don't know when that's going to dry up. But the fact is people need a place to live. Single family and residential markets are going to continue to be strong. The biggest unemployment numbers are coming out of the mortgage market and out of the commercial brokerage market. People are being laid off left and right. It's going to affect employment sooner or later. The Fed's looking in the rearview mirror. Unemployment's a lagging indicator. Inflation's a lagging indicator. But by the time the forces that we talk about in terms of consumer price index and producer price index wash out, that's when the Fed will react. So they're going to overshoot this inflation market, and they're going to drive down the economy hard and fast. And we're going to see a lot of pain, and we're not going to see it probably for another 3 to 9 months. But when we see that pain, it's going to be real. And you're going to see foreclosures, you're going to see auction. There's going to be opportunity out there. Never hurts to keep without a drop.
Awesome.
Yeah, no, I watch the new builders from Erie north up into Fort Collins, right? And I follow everything that they do, and I go to the showrooms, and I listen to them, and some of them are my clients. And here's what they say, and these are smart operators, right? So first of all, January, if you went there and you tried to buy something, you had to wait, you got into a lottery. Yeah, it was crazy. Now, they all have incentives, including even if they don't show them, each one of the sales agents has a pocket incentive. That's number one. Two, I know one builder that didn't sell anything in June and is sitting on 18 houses right now, which is crazy for that kind of market. Now, they had trouble pricing everything with the raising costs, so they didn't know how to price their lumber and all that stuff, so they waited. But they're sitting on stuff, so that's starting to move. And at three, it's like at their show houses and that, people just aren't walking through the door like they were at all compared to before. So they know that there's something. And so what they're doing now is they're selling off all their multifamily land, they're selling off of the other stuff. They're actually getting liquid where they can as well. They're definitely seeing something. So they're always a bellwether for me for what's happening. And it just, whatever they do, I just watch them and that tells me what's coming down the road. Because they're generally right about it. They're going to plan their money out the one way.
Ross, I mean, to your point, though, they're also part of the problem. They're also part of the inflation problem because they're the ones that were price gouging when, like when COVID started, the cost of materials quadrupled, but they never adjusted when they went back down. So I had buyers last year that, a house would fall out of contract with a new build, and because of that 2-month period, somebody lost their job or something happened, the original buyer fell out of contract, they raised the price to $50,000, $60,000, $70,000 for a buyer that went under contract and was able to close in that same time period, as soon as the house was completed. So I just wanted to point that out. Like they got a little greedy. They weren't even paying realtors. They were paying us flat fees or 1% fees, and I mean they never adjusted. So I mean they're kind of it's coming back around.
Well, their pricing's coming down now. It's not going up anymore.
And they're starting to pay.
And they're going to say,
It's funny how that works.
You can buy single-family residence for below 600 from Erie, which is just crazy. It's just crazy.
Tammy?
Food for thought. Is it better to owe $500,000 to a bank at 3% rate or owe $250,000 for the same house at 6% rate?
I'm sure I did my number. I really calculated the number. So I bought a house for a client.
Louder.
Louder. I bought a house for a client. I think it will close on January this year. 540. And I think 2 weeks ago I calculated the same house, same rate. I mean rental rate, everything same except to change my return at that time and return as right now. So I have to, so with a 6% interest rate, I think they had to straight half that time, in January. In fact, they locked in January. So same house have to, the price has to reduce to below 420, barely meet when they bought at 540. That's the number I literally calculate. So then I can buy as today, say, what's the price I can buy as today and meet, that. Does that make sense? Yeah.
I guess I'm thinking about consumers because that's my business and we're supposed to protect consumers. I think about all the investors I refinanced back in 2012 and they were refinancing their $120,000 houses that were at 6%, and then the rates started coming down and we refinanced them, and now they have dirt cheap mortgage payments, and now they have nice fat rent checks. And I mean, that's the way to go. So if prices go down, lots of opportunity, just saying.
Yeah, absolutely. I mean, you hit the nail on the head. I mean, just figure what 10% in affordability for every 1% of the interest rate. It doesn't necessarily equate to price, but it just means that the higher interest rates, we got to buy better. Prices have to come down to make investments make sense.
I mean, along those lines of going back to kind of the smaller price points out of state, because I pencil up rental loans all throughout the country. And when you go to Pennsylvania, Ohio, Texas, the way we, from a lender's perspective, we look at the DSCR, debt service coverage ratio. So it's how much rental income you're getting relative to the main expenses of the property, which are your mortgage payment, taxes, and insurance. In the bigger cities and on the West Coast, these ratios aren't great. In California, you have $1 million home that you're renting out for $5,000 a month and you got $12,000 in annual taxes. The numbers are terrible. Denver, and similar with a typical single family house, say in the tri-state area. Denver's kind of in the middle. Once you start getting out to $200,000 homes, I have one investor in Sherman, Texas, about an hour outside of Dallas, kind of a military type town. His properties are worth between 150 and 200K, and his rents are between 1,700 and 2,000 a month. His debt service coverage ratio is over 1.5. So when you have that high of a debt service coverage ratio, it doesn't really matter if the interest rate goes up half a point or a point. Rents have been staying strong. I mean, every market's a little bit different. I'm talking more nationwide. I haven't been seeing an issue with these debt service coverage ratios because rents have stayed strong, at least in reasonable price point type areas. Once you start getting into multi-million-dollar homes, bigger price points, it's hard to get the rents to support those types of prices. So as long as you find the right ratio and the right price points, in Southern California, my flippers are having problems. Since the ARVs have been coming down, kind of the strategy that I'm seeing from my SoCal flippers is they're starting to put more ADUs on the property. So the initial plan was to put lipstick on the pig, get it sold, but now that they're not getting the juice on the ARV, they're going to put 1-2 ADUs in the back. So I'm going to get them a second loan to refinance to do the construction, and then there'll be a third loan to take that out to a permanent rental loan. And once you have multi-units on a property, now you have a $1.2 million property getting 10, 12K a month instead of a $700,000 property only getting 3K a month. So it's all about the ratios at the end of the day. I mean, we can argue about the strength of the economy, where interest rates are going, but if you have enough cushion, then you can kind of weather out these temporary bumps in the road.
All right. I know everybody else wants to talk more, but like John always used to tell me, keep it on time, keep it on track, and don't let it go over, because this is the time we need to network.